The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now here on Market Talk, always great to have a conversation with David Widmar, economist with Agricultural Economic Insights, and talk about the latest in the markets and the ag economy and much more. And he is with us here today. David, great to catch up with you again, my friend. I hope you're doing well.
Always great to chat with you, Jesse. Thanks for having me on.
Well, I appreciate the time. Let's dive in here. And obviously, we are a few days removed from that big May World Agricultural Supply and Demand Estimates report. And we've been seeing a lot of volatility in the markets here. I mean, a lot of downward movement. You and I were chatting before we came on the air here. I mean, corn, we've lost at least $1 here in how many months, if not more. So plenty of things to really kind of take a look at as you step back though and think about that WASDE report and some of the surprising numbers. I know the carry out number in corn was a big one, but what's your take on just how that WASDE report shook out and the effect it's had on the markets in the last few days?
Well, the first thing to keep in mind is it was the first official estimate for this 23-24 marketing year. And so there is always a bit of a sticker shock that comes into that. The first one, of course, is acreage. Acreage is up. We won't really get a better picture of acreage until the end of June with that acreage report. So that's the first one that really pushed this production up. The second one is that 181.5 yield that they put in. There's a lot of really smart people debating this. We've been stuck in this 170 bushel club for corn yields the last few years. Really, it's 5 or 6 years. And so, in our opinion, I think the USDA's opinion as well, I don't want to speak for them, but 181.5 is sort of this normal starting point. And we'll see how that plays out over the next, growing season, but there's a wide range of outcomes, both above 181.5 and below 181.5. So we'll see how that plays out. The final piece here is usage, and I lump a whole bunch of lines of the WASDE report into one. Usage, broadly speaking, we had usage that was about 1.3 billion off the trend line of usage that we monitor. And if we have 181.5 bushel crop, if we have these acres, we're going to have to turn the demand engine on. We've got to get usage back in gear. We were in rationing mode. Now we need to encourage it. So the USDA came out with more usage on the corn, more usage on soybeans, but we didn't get back to that trend line yet. So the big question here is, how much lower do prices have to go to re-engage demand, to really get usage or quantity demanded, get that usage back into gear? I think we're in a situation where all these commodities are sort of on this knife's edge. If we have tight production, tight stocks, commodity prices are going to have to be very, very strong to ration usage, ration demand. If we see a rebuild in inventories, we're going to have to see prices come down to really get that quantity demanded back into place. So unfortunately, prices are going to be the lever that we pull, and we'll let you to decide if it's to the upside or the downside and how that plays out for your business.
Well, and thinking about that 181.5, as of now at least, corn planting progress in most areas has been pretty good to maybe put us on target to hit that potentially. But I know obviously we still got a long ways to go to get to the finish line. I know you guys have been doing some work and you've been looking at corn planting progress and looking back, many years as well. I mean, just touch on planting progress a little bit, David. What's the kind of the gauge you're hearing as you talk to producers across the Midwest right now?
Well, the thing to keep in mind is 70%, technically 68% to be precise, by May 15th is the threshold that the USDA is watching for. It got really close. What we look for is these 10 percentage points or greater deviations. If it gets we get close to 80% of the crop planted by the middle of May, it's beneficial for yield in the USDA models. If it's below, say, 60%, they're going to start penalizing yields. It's a pretty darn normal planting pace for the crop across the nation. Of course, you're going to have states like Missouri and Illinois that have been going really quickly. States like Michigan and Wisconsin are a little bit slower, but we have this situation that on average, the corn crop is going in pretty well.
Well, David, let's talk price, and let's talk specifically on corn price. I'll pull up another chart on the video feed. You guys do a lot of great work, ask a lot of great questions of producers on your website, aei.ag, both the free and the premium side. Thinking about corn price, though, and you mentioned this to me off air, seeing where prices have come down to now in the recent months really feels like a time where, as a producer, got to sit down and kind of recalibrate, I think was the term you used, our marketing plan and kind of rezone in on things here and sharpen that pencil a little bit, David.
Yeah, so thinking about specifically 2023, a lot of folks sit down and made their budgets back in January and February, and there was, we were getting really close to $6 per bushel corn, $14.50 soybeans, and we're just not there today. And now that's not to say we won't get there by the end of the growing season or get there by harvest, but we have to kind of challenge ourselves to say, okay, when I make these budget estimates in January, what prices would cause me to revisit my marketing plan, revisit my budgets, revisit my overall financial projections? And I think for most of it, it's a dollar. If you're thinking about 150 or 200 bushel corn yields, these are several hundred. We're getting close to $200 an acre in revenue swings. So it's time for us to revisit that. We look at the economic cost of production. We're getting close to a break even at these prices, and so not going to say that we need to tighten the fiscal belt, but we're stepping out of this period of strong profitability. Now, this is for 2023. When we think about sort of what lies ahead of us, maybe 2025 to 2030, what's going to be a normal corn price? And, producers can kind of quiz themselves. What's going to be this kind of typical price I can market my corn from in the next 3 or 5 years? I was at a conference several months ago, and one of the speakers said, well, I'm really pessimistic. I think it's going to be around $5 a bushel. So we put together this chart that shows the market year average corn price going all the way back to 1970. And we can see that there are several years where we have these big spikes. If you think back to the 1970s, we had $3 corn 3 times between 1972 and 1982. And then it took all the way to 1996 to get back to $3 corn. And of course, we all remember the story. We crossed the $3 threshold in the early 2000s, and we haven't really fallen back below that. The other thing to keep in mind is we were at higher nominal corn prices back in that 2012, 2013 window, and we fell back to $3.50 corn. Again, I'm not going to try to forecast or guess where we're going to be with corn prices in 5 to 7 years, but I think it's worth pausing and saying, okay, what's the range of possible outcomes? And how do I start making decisions in the long run, especially when it comes to farmland purchases, long-term cash rental agreements, or even buying equipment and making payments for multiple years? We really need to be careful about that fixed cost structure of our business and how that plays out in the years to come.
Very, very true. Well, thinking about some of those cost structures as well, I always like to pick your brain on just the general ag economy and thinking about where things stand with farm capital, et cetera, et cetera. I know you guys are doing some work on that right now behind the scenes there at AEI. What can you share? What are your thoughts with just this general ag economy as it stands right now, David?
Keep in mind the last 3 years, at least based on February projections, it might not be nearly as rosy given the current commodity price situation, but we have had 3 really good years in U.S. agriculture. And so that's propped up farmland values, that's propped up the balance sheet. And so we're starting to say, well, how good is the balance sheet? How strong and resilient are working capital levels? And it's one of those situations where average is maybe a little bit misleading. There are some producers who have built up really strong working capital reserves, and working capital is our current assets minus our current liabilities. We always say it's the first rung of the risk management tool. It's the original risk management tool. But on the other side of the story, on the other side of the coin, there have been producers who have gone out and made big purchases of farmland, or maybe they've gone out and bought new pieces of equipment, and they've used that working capital. They deployed that working capital to make improvements for their business down the road. And so we need to stop and think about this. Okay, how much working capital do I have on my operation? What levels am I comfortable with? And then how do I make plans going down the road? We need to make sure that we're keeping our eye on this. It's not a bad decision to deploy it, especially when a good opportunity presents itself. But we want to make sure that we're rebuilding our working capital, especially since the cost of planting the crop, it's the most expensive crop we've ever planted. And that's significant because that means we have more skin in the game and more risk on the table. So we plant this $5, $5.50 per bushel crop to plant, to cost of production. What are we going to be able to market it for? So these are the things that we're thinking about. These are the things we're keeping our eye on as we move through the growing season.
Well, David, great thoughts as always. Before I let you go, anything else on your mind? Anything else you want to reiterate to folks? I know, again, you guys do a lot of great research there at AEI. AEI.ag is your website, the free and the premium side, a lot of stuff there. Anything else you want to mention for us today?
Well, we're keeping an eye on farmland values. A really important data set to us comes out in the summer. We're keeping an eye on that, both cash rental rates, farmland values, and this capital, this cap rate, this relationship between the income that an asset generates and the asset's value. I think the other thing to keep in mind is, we talked about this yield contest last time we chatted, Jesse, and it's been interesting because we asked questions about the next WASI report, so the June WASI report in this one, but then also this long burn question. What's the USDA projections going to look like in the fall? And folks are a little, I guess there's about a 40% forecast against the consensus that it's going to be above trend, so that 181.5 number the USDA put out. And so I think that reflects that folks are anticipating a below trend crop this year, kind of on average. Why is that the case? Is it something to do with weather? Is it something to do with, kind of thinking that's a big number? I don't know, but I think it's worth pausing and challenging our own assumptions about where the crop might be, what the ending stock situation might be, and how that fits into our marketing plans. Just want to make sure folks aren't betting on $6 or $7 corn next fall and 2% interest rates at the federal level. It could happen, but that would be a really bullish case for U.S. agriculture, and that's not where the cards are stacked at the moment. Again, wide range of possible outcomes. We need to build marketing plans and production plans that can adjust to those various outcomes.
Well, that is a great thought to wrap up on. With that, David Widmar with Agricultural Economic Insights. You can learn more about them online, aei.ag. David, always great to talk to you. Thanks so much for the time. We'll talk to you again soon.
Thanks, Jesse.